One decision, 30 seconds, 7 years of damage. That's not a horror movie plot. That's what happens when you make the wrong move with your credit and nobody told you the rules beforehand. Welcome to Warren's Portfolio. Here's the number that should stop you cold. 68 million Americans currently have a subprime credit score below 670, and the majority of them didn't get there through reckless spending. They got there through 5 specific, completely avoidable mistakes that the credit industry never clearly explains. Your credit score controls your mortgage rate, your car loan, your apartment application, your insurance premium, and in some states, your job offer. A 100-point difference in your score can cost you $200 more per month on a mortgage every single month for 30 years. That's $72,000 from one number that most people don't understand. My name is Warren, and today I'm going to show you the 5 mistakes that destroy credit scores and exactly how to never make any of them.
Before we get into the 5 mistakes, here's what you need to understand about how credit scores actually work. Your FICO score, the one lenders actually use, is calculated from 5 weighted categories. Payment history is 35%, credit utilization is 30%, length of credit history is 15%, credit mix is 10%, new credit inquiries are 10%. Every single mistake on this list attacks one or more of these categories directly, and some of the damage takes years, sometimes 7, to fully clear. Let's go. Mistake number 1. Missing a single payment. This sounds obvious. It is not obvious enough because 35% of your entire credit score lives or dies on this one category alone. Here's what most people don't know. A payment that is 30 days late is reported to the credit bureaus as a delinquency, not a warning, not a flag, a delinquency, the same category used for serious credit failures. And that single 30-day late payment can drop your score between 90 and 110 points overnight from one missed payment on one account. Here's the part that makes it worse. That delinquency stays on your credit report for 7 years. 7 years of damage from one forgotten bill. And the higher your starting score, the harder the fall. Someone with a 780 score who misses one payment loses more points than someone with a 620 score who misses the same payment. Because the higher your score, the more the bureaus assume you know what you're doing. One mistake reads as catastrophic. The fix is permanent and takes 5 minutes. Set every account, every card, every loan, every utility that reports to bureaus on auto pay for the minimum payment. You can always pay more, but autopay protects the one thing you cannot afford to lose. Mistake number 2, high credit utilization. This is the silent killer of otherwise healthy credit scores, and it operates on a timeline that surprises almost everyone. Credit utilization is the ratio of your current balance to your total available credit. If your credit limit is $10,000 and your current balance is $3,000, your utilization is 30%. Most people have heard stay under 30%. That's the myth. The truth that high score holders know is that elite credit scores, 780 and above, typically maintain utilization under 10%. Here's why this matters more than most people realize. Utilization is recalculated every single month when your statement closes. It is not a historical average. It is a live, current snapshot, which means it can hurt you fast and it can help you fast if you fix it. A utilization jump from 10% to 80% in a single month can drop your score 50 to 100 points, even if you pay the entire balance off by the due date, because the bureau sees your statement balance, not your payment.
This is the statement date trap, and it catches people who think they're doing everything right. The fix? Pay your balance before your statement closes, not just before your due date. That single habit change can add 20 to 40 points to your score within one billing cycle. Mistake number 3, closing your oldest credit card. This one feels counterintuitive. You've paid off an old card, you don't use it anymore. Closing it feels responsible. It is one of the most damaging moves you can make to your credit score, and it hits 2 categories simultaneously. First, length of credit history. Your oldest account is your credit anchor. It tells the bureaus how long you've been managing credit. Close it, and your average account age drops immediately. A drop in average account age can cost you 15 to 40 points depending on your overall profile. Second, available credit. When you close a card, that credit limit disappears. If you carry any balances on other cards, your utilization ratio instantly spikes because your total available credit just shrank while your debt stayed the same. Double damage from one decision that felt responsible. The fix is simple. Don't close it. If it has an annual fee you don't want to pay, call the issuer and ask to downgrade to a no-fee version of the same card. You keep the account age, you keep the available credit, and you pay nothing to maintain both. Mistake number 4, applying for too much credit at once. Every time you apply for a new credit card or loan, the lender performs a hard inquiry on your credit report. A single hard inquiry typically reduces your score by 5 to 10 points temporarily. That sounds manageable. Here's where it becomes dangerous. When people apply for multiple credit products in a short window, a new car loan, a new credit card, and a store card in the same month, the bureaus see a pattern of credit-hungry behavior. Multiple hard inquiries in a short period signal financial desperation to the scoring model, even if your intent was completely rational. exceptional. The score impact compounds, and the applications themselves create a visible cluster on your report that lenders read as a red flag when you apply for anything significant, like a mortgage, shortly afterward. The fix? Space applications at least 90 days apart, ideally 180 days for major credit products. And before any significant application, like a home loan, freeze your credit application activity entirely for at least 6 months. Mistake number 5. Ignoring errors on your credit report. This is the mistake most people never even know they're making because it requires checking something most people never check. Federal law entitles every American to one free credit report from each of the 3 major bureaus every year through annualcreditreport.com. A 2021 Consumer Reports study found that 34% of Americans who checked their credit reports found at least one error. 34%. 1 in 3 people walking around with a credit score damaged by information that is factually wrong. These errors range from accounts that don't belong to you, a result of identity mix-ups or fraud, to incorrectly reported late payments, incorrect balances, and accounts that should have been removed after 7 years but weren't. Each error is quietly pulling your score down, and none of them fix themselves. The fix? Pull your reports from all 3 bureaus at annualcreditreport.com right now. Dispute every error directly with the bureau in writing. Under the Fair Credit Reporting Act, bureaus are required to investigate disputes within 30 days. A successful dispute removal can add 20 to 100 points for free within 1 reporting cycle.
Here is your complete protection plan. 5 mistakes, 5 permanent fixes. Fix 1. Set every account on autopay today. Minimum payment every account, non-negotiable. Fix 2. Pay your balance before your statement closing date, not just before your due date. Keep utilization under 10% at the time your statement generates. Fix 3. Never close your oldest credit card. Downgrade it to a no-fee version if needed. Keep the account age and the available credit alive. Fix 4. Space every credit application at least 90 days apart. Freeze applications entirely for 6 months before any major credit event, like a mortgage. Fix 5. Pull your credit reports from all 3 bureaus right now at annualcreditreport.com. Dispute every error. This is free. It is your legal right, and it could add points to your score before the week is over. Here's the truth the credit industry doesn't package neatly for you. Your credit score is not a measure of how good you are with money. It is a measure of how well you understand the specific rules of a specific scoring system. Most people are losing points not because they're irresponsible, but because nobody explained the rules clearly enough to protect them. Warren didn't have a perfect credit history. He had a corrected one, and the difference in what he paid for his car loan after fixing his score was $4,800 over the life of the loan. And if you want to see exactly how to rebuild a damaged credit score in 12 months or less, step by step, even with late payments already on your report, that blueprint is coming in the next video. Subscribe now, because your score is either working for you or costing you money right now. There is no neutral. This is not personal finance. This is financial warfare. And the credit score you protect today, that's the one that saves you tens of thousands of dollars every decade for the rest of your life.